another DeFi Raiders AMA. My name is Relentless. Today I'll be speaking with Matthew from, is that how I pronounce it?
Yeah, most of my friends call me Matthew, but Matthew, Matt, yeah, whatever works.
Okay. All right. We're speaking with Matt from Infinity Pools. That way I don't butcher it on you. A decentralized exchange that offers unlimited leverage on any asset, no liquidations, no counterparty risk, and no oracles. Really appreciate you coming on today. Looking forward to this. When you think about what you guys are offering here, it almost sounds kind of impossible, even for someone like me who's not a great trader or not an avid trader, but familiar trader. It's a super cool concept to think about. So super excited to talk about this. So thanks for joining. You want to kind of go ahead and give your introduction and then kind of a background for yourself or the project?
Yeah, sure. Would love to. And, thanks for having me on. Very excited to tell more people about Infinity Pools and what we've been up to. My background, I mostly started out as a computer scientist, an engineer, studied computer science at Columbia, then was a quant at Goldman for a little bit on their structured products team before transitioning into a quant in crypto. One of the first trades that I really ran was the kimchi arbitrage, right? That famously Alameda also did. That ended up being like your only profitable trade ever. And but after that, I transitioned more into arbitrage and market making. And after that, was decided that trading wasn't really like the thing for me. I preferred building, and so I went to work for a firm, a professor of mine, doing research, filing patents on that research at a small think tank / startup that he had started. And my last job before starting Infinity Pools was as a product manager at a fintech. As for Infinity Pools, the story there is quite peculiar because, originally what we had built was Lemon Finance, right? Like the team behind Lemon Finance was the same team that built Infinity Pools. And for those of you that don't know, Lemon Finance was another protocol built on top of perp dexes. And because, we were built on top of perp dexes, I think that we are extremely well positioned to know exactly what the pain points of perps and building on top of perps were. And I like to think that, that familiarity and like really feeling the pain points firsthand was one of our big drivers for later on building Infinity Pools.
Yeah, very cool. I mean, what was kind of the what made you guys want to transition from perps to this, or from Lemma to this?
Yeah, for sure. So I think there were a couple like different like factors that really like made that decision easy for us. The first one being that, and honestly, like the most significant factor was that like we weren't seeing like the growth that we wanted to see out of the derivatives market, and specifically perps. Basically, when I got back into DeFi in 2020, like Uniswap and like spot trading had exploded in volume, and my thesis coming in was, well, derivatives is going to do to spot what it does to spot in every other, centralized traditional finance markets, and do an order of magnitude more volume than spot. And I think where that thesis kind of like failed was that, Uniswap, the reason that they were popular was not because it was trading on chain. It was because they had really done a 10x improvement on, their incumbents, right? So like they could list 10x more assets than Binance, but they could also list those assets 10x faster. Whereas like perps, and specifically DeFi perps, right? They had just kind of taken what was already off chain and just copy and pasted it on chain, which didn't really have any 10x improvements, just worse experience overall. And so, as we got increasingly bearish on perps, we decided to essentially like create our own exchange, and with a 10x improvement, and we would have been happy with one 10x improvement, and Infinity Pool ended up having like 5 different like 100x improvements over pretty much every other traditional financial instrument out there. So we were actually quite taken aback by how powerful the primitive and protocol that we had created was. So yeah, it's that's kind of like the origin story.
Very cool, very cool. Yeah, I'm kind of excited to figure out like all the improvements that you guys have made that you guys are excited about here. So first, what I really want to cover first is kind of some of the background stuff that makes this so important, and so that people have an understanding of why you guys built what you built. So first, let's talk about, because what you guys are offering is the zero liquidations and the unlimited leverage. So first, let's talk a little bit about the constraints of leverage that you've seen previously, historically, but then also the importance of leverage and why it's so necessary to actually have that to be successful.
Yeah, absolutely. So maybe I should start really with why leverage is necessary, right? And
yeah, absolutely.
And this is like a very hot take, but like why I think it's actually necessary for retail. Currently, retail and specifically people that do not have large capital bases, in order to invest and make money investing, they need to essentially make that investment be worth their time, right? Like they need to essentially justify the fact that when they invest in a given stock, a given token, whatever, they need to make sure that the time they spent researching that token will essentially be worth their time. And I mean very much from a financial, am I gonna get like, like what am I getting paid essentially for this? And the problem is that when you've got $100 in your savings account or whatever, it's unless you invest in like Bitcoins with extremely dubious fundamentals, you're just never gonna get that ROI, right? Like it's just never really gonna be worth your time because, like if you make $3, by investing that like $100, like that $100 in like Ethereum, it's nice, but it's nothing exciting, and it's nothing that's like really going to like be worth the research that you put in. Now, what if you could use leverage, and then with leverage you could actually make the same amount of money investing in Ethereum than you would have by investing in some random shitcoin? Well, then all of a sudden, retail investors and pretty much anyone can come in and start investing in projects that have very strong fundamentals, right? It essentially opens up the type of investments that can receive funding. So, even just from that point of view, what we're really doing at Infinity Pools, and the way that like I really see it, is that we're democratizing access to capital, right? We're making sure that everyone can essentially trade based on insights and not based on the capital that they have on hand. So that's kind of like my argument for why leverage is necessary. Now, the second thing we wanted to cover was what are the current constraints with leverage today. Really, all financial instruments, or a lot of financial instruments today, like the majority of volume comes, from futures, margin trading, perpetual futures, that kind of stuff. And all those instruments have a common point, which is that all of their constraints can be traced back to a single problem, which is liquidation risk. What do I mean by that? Basically, all of these instruments, like the way they work, can be distilled into some variation of the way that margin trading works, right? So like they're very similar to how margin trading works at a high level. What that means is, to go long Ethereum, essentially what you're doing is that you're borrowing cash, then you're swapping that cash for Ethereum. If the price goes up, everything's good because you can swap that Ethereum for USD at any point, repay the loan. But the problem is that when the price drops, you need to be able to liquidate that Ethereum that you hold for USD for the cash that you originally borrowed. And you need to do that before the price falls enough that when you sell that Ethereum, it's no longer worth the cash that you borrowed, right? So essentially, you need to be able to liquidate assets fast enough and with sufficient, efficiency, from a slippage point of view, that you can repay your original loan. Now, doing that extremely fast and extremely efficiently is really, really hard, especially on large price moves, right? And when you think about long tail assets that have extremely thin liquidity, the problem gets 10 to 1,000x harder, right? Because all of a sudden the slippage is no longer 1 to 2%, it's 10 to 15%, and all of a sudden it's basically impossible to repay the original cash loan if the price drops 50%, because obviously these coins are pretty volatile. So essentially, and by the way, the same thing happens in traditional finance, right? Like traditional finance, you have margin calls, but it's even worse because these margin calls can take 3 to 4 days to actually happen. So there's 3 to 4 days in which an asset's price can drop. And what that means is that obviously then the leverage that you have available in traditional finance is much lower than the leverage that you have available in crypto and on perpetual futures. Basically, the crux of the Infinity Pools innovation, really where we managed to really innovate, is that we managed to create a way to guarantee that all trader positions would always close perfectly. Essentially, we got rid of liquidation risk. And when you get rid of liquidation risk, then all of these other problems that I just mentioned go completely away. You have unlimited leverage on any asset with no liquidations, no counterparty risk, none of that. And yeah, it literally just came from this simple fact that we eliminated liquidation risk.
Yeah, awesome, very cool. So with that, then let's talk about what are the problems with liquidations for both users, exchanges, and then also the risks that are faced by counterparties from that as well.
Sorry, can you repeat that?
Oh, I was just trying to say the inherent problems of liquidations, if you want to talk about those. Yes, it's great that you eliminate them, right, and the user doesn't have to worry about it necessarily, but do you want to kind of talk about also why that's so important to the exchanges and the counterparties?
Yes. Okay, cool. So really, there are a bunch of problems with liquidations that actually really go unnoticed, and that people don't talk about enough. And actually, the first one I'll talk about is liquidation penalties, right? So people are familiar that when your position gets liquidated, liquidators actually take anywhere between 1 to 3% of your entire position as a liquidation penalty. And what that usually means is that you have a huge, essentially, fee just, when the price moves against you. And where that really hurts is for traders and their expected returns. We actually ran basically a synthetic data simulation where we looked at the effect of liquidation penalties on expected returns for traders. And we noticed that for a trade over a week with a Sharpe of 1, which means that it's a directionally correct trade, right? You're going long ETH and the price is going up. After 15x leverage, traders actually expect to lose money, which means that even though your trade is correct, you should still expect to lose money beyond 15x leverage, which is obviously absolutely insane. So I guess I'll start there. And then the second point, right, which you mentioned, which is exchanges, et cetera, like counterparty risk, right? So, I think everyone on this like Twitter space is familiar with the more classical centralized custodian risk of FTX and Binance, right? Where, one day all of your custody funds could be gone, like the next day because fraud, et cetera, et cetera, et cetera. But like one thing that they're less familiar with is the counterparty risk of perps themselves, right? So this is something that even DYDX, Mango Markets, Perpetual Protocol, like they all have it, right? This is counterparty risk that is specific to perps as a financial instrument. Basically, perp markets only work as long as liquidations are being done efficiently enough, right? So let's say that a trader goes long Ethereum 10x and they make millions of dollars. And on the other side, you've got a short trader, right, that like lost the exact same amount of money. But let's say that the liquidator that came in and took over the short position to liquidate it couldn't do it efficiently enough in time. Where does that bad debt go? Well, if enough bad debt accumulates, then what happens is that there is a forced settlement of the market. And this is actually something that happens much more often than people might think. Essentially, what happens is that the market, the perpetual market, just stops. And profitable traders don't get paid out. Short traders, they're liquidated regardless. Market makers also get wrecked. And the exchange ends up with like a bunch of bad debt. So literally everyone loses. Literally it's a lose kind of situation. Depending on obviously like how bad the bad debt scenario is. Hopefully that like covers some of the counterparty risk stuff that you were asking about.
Yeah, 100%. Yeah, super clear. It covers the fees, right? The 1 to 3% of your entire position plus. With the liquidations happening, right? Even those tiny movements in price, even if it's on the way down and it moves like a ghost pump back up, right? People get liquidated, lose a ton of money. It makes it really makes your leverage a risky bet, right? So, and it's not even necessarily, we hear don't mess with leverage if you don't understand it, which I agree with. But even if you do understand it, like you said, once you get up into those high leverage trades, when you're relying on some of these things like the price oracles, which we'll get into here in a bit, that's when you get all these other risks. So, tons of risks, not just with the leverage itself, but all the mechanics that go into this, which is what I want to talk about next. So you guys are able to, offer unlimited leverage through removing the liquidations. So that's kind of what I really want to talk about is the mechanics of what you guys are doing to enable people or to enable the zero liquidations.
Yeah, absolutely. And one thing that you said, which is like, don't mess with leverage. I actually used to agree with that, right? Because once again, perps were a terrible, instrument to use, especially for high levels of leverage. That said, once again, Infinity Pools kind of changes that. So no longer, until we launch mainnet, it'll still be true. But after that, things might change. Okay. So how do we get rid of liquidations? How does Infinity Pools work? So if you kind of remember the way that I described margin trading, and the way that like futures overall worked, right? What you did is that you would borrow cash, and then with that borrowed cash, you would swap it for Ethereum, right, or any asset to go along that asset. And then if the essentially assets price went down, then you would have to liquidate that asset for the cash and repay back the loan. What Infinity Pools does at a super high level is that instead of borrowing cash in the first step, what we do is that the traders borrow liquidity. Basically, they borrow an LP token. And And that way, essentially, what they're doing is that they're borrowing a limit order against which they are 100% sure that, if the price moves against them, they can essentially close their position against that limit order that they borrowed. You can think of it as a no slippage stop loss. All traders borrow a no slippage stop loss upfront, such that if the price moves against them, they can close out their entire position at the liquidation price. Obviously, all of this also means that there's no liquidation, so they don't actually close out their position. It's more if they wanted to close their position at that price, that's how it would work. A little more concrete example that I use in the Medium article is, let's say that you've got a ETH USDC pool, right? And let's say that the current market price of Ethereum is $1,000. And let's say that a trader comes in, wants to go long Ethereum. So what they do is that they borrow an LP token worth 1,000 USDC that's deployed at the $900 tick, right? So it's all concentrated on a single tick. What they do is that they redeem that LP token for the 1,000 USDC that backs it. They take that 1,000 USDC, they swap it for 1 Ethereum, right? Because once again, the market price of Ethereum is 1,000 USDC. And then, if the price of Ethereum goes up, everything's good, right? Because once again, they can take that 1 Ethereum, sell it for, 1.5K, whatever, use $1,000 to repay back, to mint back the LP token at $900, and give it back to the liquidity provider, and then, pocket 500 USDC in profits. Now, if the price moves against them, then let's say that the price goes to whatever, like $900, right? If the price goes to $900, then the trader has lost 100 USDC, right? Because essentially what happens is that the 1 Ethereum that they have on their balance sheet can only be sold for 900 USDC. Once again, they borrowed LP token at worth 1,000 USDC. So, they're in the hole by 100 USDC, which means they need to start out with 100 USDC in collateral. Now, the question you might have at this point is, okay, well, what happens when the price drops below $900? Well, this is where things actually get interesting, because the liquidity provider below $900 is no longer expecting USDC back. They're actually expecting 1.1 Ethereum, right? Because this is 1,000 USDC converted to Ethereum at the $900 range, right? That's how impermanent law works. So the trader already has 1 Ethereum on their balance sheet, and then so they only need 0.1 Ethereum more. But that 0.1 Ethereum is always worth less than 100 USDC below 900 USDC per Ethereum, which means that the maximum loss that the trader can have versus denominated in the liquidity that they borrowed is 100 USDC. Does that make sense?
Yeah, I'm picking it up. Okay. Complicated, but it makes sense. So their risk is really, they can go unlimited leverage, but they borrow. Their risk is really just that upfront capital and not the full 1.1 ETH per se.
Yeah, correct. So
okay.
Once again, the traders start out with $100, and with $100 they can borrow up to $1,000, which is 10x leverage, right? So when traders use LP token that's 10% away from market price, that's once again 10x leverage. But if the trader had instead borrowed an LP token at $999, then what would have happened is that the maximum loss would have been $1, which means that they could have started out with $1 in collateral to borrow 1,000 USDC, which is 1,000x leverage.
Okay. All right. Cool. That makes sense. All right. Okay, so that covers it from the trader's perspective. One question I have with the trader's perspective before we move on to the liquidity providers is, what are the fees associated for the traders for entering, exiting positions and stuff like that?
Yeah, so fantastic news for all traders out there. There's basically going to be zero slippage, even from day one. The reason for that is that while the borrowing of the liquidity is done using Infinity Pool's liquidity, right? So this is something that affects interest rates, right? So interest rates is going to depend on Infinity Pool's liquidity. But to actually enter and exit the position, right? So the swap fees, you can actually use any DEX aggregator. And if we launch an L2, there are plenty of exchanges out there that offer no slippage type orders, right? So essentially, you can plug into any of those to actually execute the swaps. We're going to launch with zero slippage, essentially, or very, very little. Basically, whatever is the best market price you can find.
Okay, very cool, very cool. All right, so then from the liquidity provider's perspective, how do they make money?
Sure. Basically, it's the exact same UX and payoff function as Uniswap V3, right? So you still have impermanent loss, but the big difference is that you have three advantages with Infinity Pools. The first one is much higher yields, and in fact, actually, this one is one that's pretty funny to me, because a lot of people on Twitter always ask me, are LPs going to get compensated fairly, for their yields, et cetera, et cetera. I think that they've all been traumatized by UniV3, and I actually have the exact opposite concern, where I'm liquidity providers on our platform are actually probably going to get paid too much, and so we need to bring on more liquidity providers, to really stabilize the yields. The first one is much higher yields, and we're actually going to publish a small article on this, but essentially there's there's a soft floor on the yields that can be generated by LPs, and this floor is realized vol. It's a soft floor, but essentially another way to put it is, in the very worst case, we actually expect that LPs will not lose money, which is better than most AMMs out there. That's the first advantage. The second advantage is that LPs actually generate yields even when their liquidity is not in range, right? So even if they deploy liquidity between $800 and $900, and the market price of Ethereum is at $1,000, LPs are still generating yield. Kind of a really, really cool thing, and we're the only ones to do that, as far as I'm aware. The third and final really huge improvement is just-in-time liquidity proof yields. Right, so one of the things that's become more and more popular lately, especially on Ethereum mainnet, is high frequency MEV searchers, looking for big swaps happening, putting in liquidity for one block, and then pulling it out as soon as the swap happens, thereby essentially extracting a disproportionate amount of the fees and rewards that would have otherwise gone to more passive liquidity providers. So, yeah, basically, because the yields on Infinity Pools are distributed continuously and not in discrete time chunks, right? These are streaming payments to LPs. There is an advantage to putting liquidity in for one block and then pulling it out. So, Infinity Pools, fantastic for liquidity providers. and passive liquidity providers in particular.
All right, very cool, very cool. And so then from a protocol perspective, right? Where are you guys generating all of your revenue for the infinity pools?
For sure. We're still thinking through a lot of it, but the really nice thing is that we are so close to the money in so many different respects that there are a bunch of different ways that we could actually collect both protocol and other types of revenue, right? So, for example, one of the things that we've been thinking about is payment for order flow-ish type thing on the swaps, right? So, once again, instead, currently the way that we do things is that like when a swap is done on our platform, we just would reroute it to a DEX aggregator. But you could theoretically just make sure that like the best price is given, and then the fee would go to you, right? So like to the protocol. Essentially, yeah, just fees on swaps. There's also like another interesting thing that's like there's basically a surplus that's created. It's a super in the weeds kind of thing. I really don't want to get into it on the podcast, but there is essentially like a really cool surplus that's created where I'm not super sure who even like is ultimately paying the price for that surplus. But yeah, it's essentially there are a couple like different ways that we're thinking about it. It's not solidified yet. I'll put it that way.
Yeah, totally fair. I know you guys kind of came out of stealth mode in a way, and then I know you guys are still working through some stuff, so I'm interested to see some of that. But I mean, the fact that you have obviously that everybody has access for all the DEX aggregators to pull from there to enter the LPs through there is obviously super helpful and gives you a lot of leeway to develop the liquidity the way you see best for the infinity pool. So awesome, super cool. Okay.
Yeah, I will say that like our testnet is coming pretty soon. We're definitely aiming for early to like mid-March testnet. So nice couple weeks.
I'll when you guys get ready to launch that, I'll pitch it to some of the people in my group. I know they'll be super interested in messing around with that. Just the idea of no liquidations is pretty cool. I mean, on top of considering the amount of money you save without the liquidation fees and all those other things is definitely going to be attractive for you. All right, so a couple other questions here. I know you guys haven't published a lot of stuff yet, but have you guys started talking through any of your tokenomics for what you're going to pay the team, what you're looking at putting in kind of your treasury or any kind of governance token, how you guys are viewing any of that?
Not really. Just because once again, I feel like most protocols launch their tokens way too early. I really see tokens as a way to they're growth levers, right? One of the best things that tokens are great at is making sure that certain metrics, certain like behaviors are incentivized to bootstrap network effects and get the protocols to hit escape velocity. On top of obviously like governance purposes.
Yeah, that's fair. That's fair. So then, what are you guys thinking about? How are you paying the team? If you're not going to take it from a token that you guys launch, what percentage of fees are you guys looking at in order to pay the team?
Currently, we have like VC funding, so
okay.
that is how we're paying the team.
Okay.
Yeah.
All right. Cool.
Yeah, we raised a seed round in December 2021, and yeah, we're probably gonna raise again. I want to say in the next like 3 months, but yes, that is the current way that
nice.
We're doing things.
And how much of a runway is that giving you guys so far?
So we still have 2 additional years of runway. So we're not raising because we need to. We're raising because, quite honestly, we're expecting a lot of growth, and so we can. And you know what they say: you should raise when you can, not when you need to. So.
Yeah, makes sense. Yeah, you got to be proactive, not reactive.
Yeah, I will also say that with 0 outbound, we've actually received so many different verbal offers from investors that around that I wasn't trying to race for is already oversubscribed. So kind of crazy.
That's a good feeling.
Interest. That's
Yeah, I mean it's an attractive concept that I'm sure that you guys have gotten pushback on before as you've pitched this. I'm sure you've been told it's impossible at some points because it almost sounds that way when you're thinking about perp trading and stuff like that. So, but yeah, I could think of a few people who are gonna love this opportunity. So, all right, so where are you guys going to launch at? Have you decided? I know I've seen some and heard some stuff about deciding on an L2. Have you guys made that decision yet?
Not yet. We're actually meeting the L2 teams in Denver over the next week. So we'll have a decision by next week.
All right, very cool. All right, and then kind of my last, we should be able to get to a couple audience questions here with some time. What are besides just being able to trade on here with 0 liquidations, unlimited leverage? What are the other use cases that are possible here?
Yeah, so there are a few that I'm actually very, very excited about that I think are going to be built on top of Infinity Pools. One of them is called Everlasting Structured Products. Basically, you can build structured products with any payoff on top of Infinity Pools that have 3 huge advantages over traditional finance structured products. That, I believe a startup is going to come in and build this protocol on top of us. So the 3 advantages are specifically, and we talk more about them at the end of our white paper, but basically, number 1, these are structured products that you can list permissionlessly on any asset with, once again, any payoff. Number 2, because these are essentially just LP tokens into Infinity Pools, you can withdraw your assets at any time. Traditional structured products, once again, have a lock-in period, which means that, DOVs have innovated around this by essentially only deploying 80 or 90% of the assets, which means that you've got 10 to 20% of users that can withdraw their assets before the lockup period ends. But then it also means that 10 to 20% of the assets are not deployed in the actual strategy. And then the last big perk of Everlasting Structured Products on Infinity Pools is that because there are no market makers rolling over your position every week, there is no need to pay market makers a fee. And there is no need to pay them a spread every week to roll over that position. So essentially, yields are also just generally higher. So that's one use case I'm very, very excited about and look forward to having, a team built on top of Infinity Pools.
Yeah, very cool. Yeah, and I encourage everyone to go and read the white paper that they've published. If you're unfamiliar with trading, you might want to brush up on some of the regular trading terms so you can understand it. But yeah, you guys got some other stuff that's super cool in there that's great to read about. So, all right. And then kind of what else do you guys have? I know you talked about beta on the roadmap. Do you guys have any exciting partnerships you want to talk about or announce?
Not yet. I think that we're really gonna do a lot of that stuff closer to mainnet. That said, yeah, we are currently talking to some very, very exciting people. Nothing solidified yet, but yeah, it's yeah. People are taking notice.
Yeah, very cool. Yeah, let the product speak for itself. I agree with that. It's organic growth. Launch the beta. And once you have a proven product, I mean, if you build it, they will come, right? So I like that approach. So, all right, so very cool. So that kind of pretty much wraps up my general questions. If you have a few minutes, I'll take some of these audience questions for a couple people.
Yeah, we'd be happy to.
All right, let me bring you up here. Cool boys, 3 Z's. Yeah, we got you. Go for it.
I must say that the utility that you are providing is amazing, and the work that has been putting is fascinating, right? So I want to wish you best of luck. So my question is basically very simple. For a layman, how this project will make money for its investor or owners, first of all, and who do you see yourself as competition, and how you have positioned yourself differently from your competition in terms of the utility, in terms of brand.
Yeah, for sure. So, I really think that our competition is any financial instrument that offers leverage on assets, right? Because in the end, we are all essentially, competing with each other. So that means perpetuals, that means options, that means margin trading, that means, anything that offers leverage. How we positioned ourselves differently is that we have, the UX of perpetual futures, which is fantastic and retail loves, while offering value propositions that are 10x better on 4 to 5 different fronts, right? So we offer 10x more leverage than any margin trading or perpetual futures product. We offer 10x more assets. We offer those assets 10x faster, right? You're going to be able to trade them on infinity pools with leverage before any other exchange. And you've got zero counterparty risk and no liquidation. So overall, you can just expect that your trades are just going to be more successful on us than other platforms overall. Hopefully that answered some of your questions.
My first question: how this project will eventually make money for its investors or owners, for a layman to understand?
Sure. So once again, one of the things that I mentioned before is that we're probably going to be taking some sort of fee on the swaps, and these swaps are going to be done using once again a DEX aggregator or whatever, and we're still trying to figure out exactly how it's going to work. To be completely honest, even from a legal perspective. But yes, that is our current thinking.
I must say the concept is really, really, fascinating, because there are so many other players as well. But the utilities that you have mentioned are something that people need. And of course, any great project needs to have a good plan, but they have to have a good community, because if you don't have a good, engaged and vibrant community, whether you have a great plan, great great projects have great community. So we talk about a lot of community building. So my last thing would be, what are your plans for community engagement for the coming 1 year, if I may ask that?
Yeah, for sure. I want to say that I already really love our current community. Some of the questions that we've seen in our white paper discussion channel have been incredible. We've had an incredibly engaged, high IQ, community, really come in and engage with our products. But then we've also had, more people that are less, familiar with, financial products, and all that stuff come in and just, have fun in our entertainment channels, playing poker on the weekends and stuff like that. So, I want to say probably just continue on that path. We're going to come out with our testnet in the next month. Probably create like some kind of like game or like incentives around that, and go from there. Hard to say what our 1 year plan is going to be when I don't know what the next 2 months look like, but yeah.
So thank you very much. Amazing stuff, and I wish you best of luck for coming times. And thank you.
Thank you.
Yeah, thanks for coming up. Great questions. All right, let me get you up here, Darius. And then I thought of something as well that I want to ask you as I was kind of thinking through some of this stuff. I'll get to you. I think it's pretty interesting. But let me get Darius up here. All right, Darius, the floor is yours. Can you hear us?
Can you hear me?
Yep.
Okay. Thank you for letting me speak. Great project. I think of you as a new innovative method in the space. I understand that there's a lot of abstraction that will take place between the protocol and the UI. And my question has to do with the atomicity of your transactions or protocol and composability. To touch on those 2 points, please. Thank you.
For sure. So, I guess I'll start with composability. I want to say that, Infinity Pools is extremely focused on composability. It's definitely one of our top priorities. As I said before, we're fully expecting for other protocols to come in and build on top of Infinity Pools. We really want to create an entire ecosystem that's built on top of our swappers. As for atomicity of transactions, I'm not super sure what the question was there, but I guess can you elaborate a little bit more on that front?
Basically, if you can use your pools and liquidity and the primitive in an atomic transaction, similar to what you can do with the flash loans.
What can you do with the transaction?
No, what I mean is if you can use this protocol in a composable way, meaning you can combine it with other transactions in the flash loan transactions, for example.
If you can combine it with other transactions. So do you mean like what I was talking about earlier with the swaps, where you can essentially use atomic swap to, get assets off of DEX aggregators? Is that what you're talking about?
So yeah, if you can elaborate on that, please. Yes.
Sure. Yeah. Basically, once again, the way that like the protocol works is that you have 2 parts to it, right? You've got the borrowing and you've got the swapping. The borrowing is done using Infinity Pools liquidity, and it's you're borrowing LP tokens. Once you've borrowed those LP tokens and you've redeemed them for the reserves backing those LP tokens, so like if you're a USDC, you can essentially swap that if you're a USDC that you've redeemed the LP tokens for, you can swap them for the other asset in the pool, right? So if I'm going long Ethereum, I'm borrowing an LP token, redeeming that LP token for USDC, and then I can swap that USDC for Ethereum using a DEX aggregator. And the reason I can do that is because it's an atomic transaction, which means that within a single block, it's going to leave Infinity Pools and be back, right? So essentially, we can guarantee that the required amount of assets are always on the protocol. And if we noticed that the swap is not successful, or the swap doesn't return enough assets, then essentially the protocol rejects the transaction and doesn't let you do the swap.
Perfect. That's exactly what I wanted to hear. Thank you.
Thanks, Darius.
Yeah, thanks for coming up. Thanks for the question. And then I had one more that I was thinking about with kind of the zero liquidation. Well, just kind of all the different features. What does this do for trading long tail assets on chain?
Yeah. So I think like one of the really interesting things that we're about to see, like people think that like leverage usually tends to increase volatility. But it's actually quite the opposite. It actually tends to reduce volatility because, you essentially have better price discovery of assets because you can short and you can long with more capital, especially if you, have a thesis as to what the price should be. So I would expect that, over the next year, the volatility of long tail assets should actually go down. And that's actually a good thing because assets that have lower levels of volatility and higher liquidity actually tend to outperform. And so I'm also like hoping that a lot of teams kind of like realize that and essentially decide to provide liquidity for their own tokens on our protocol.
Yeah, super cool. I don't know why I just thought of that, but I was just kind of thinking about there's a lot of potential advantages to the kind of long tail strategy, and so I was wondering if that was enabled by what you guys are building. So, but I guess that pretty much sums up everything that I had. We took a few audience questions, so. I just want to take this opportunity to let you have the floor and put out whatever message you want about the project.
Yeah, obviously, please join our Discord. Please follow us on Twitter. We've got some extremely exciting updates for coming for you, in the next couple weeks. So this is very much a short-term thing. If you're a liquidity provider, hit us up. We've got some fantastic opportunities for you. Yeah, and that's pretty much it.
Simple and to the point. Hey, I really appreciate your time, Matt. This has been awesome. I'm really excited to see this roll out for you and check out the beta whenever you guys roll that out here soon. And yeah, thanks so much for your time and for coming on to talk to me.